look at this mini budget and what expectations are for the 27th of October. There are those who say, if we look at three things happening on the Rand front: one, we completely abolish exchange controls; two, in addition to that, we continue with aggressive reserve accumulation, perhaps even double reserves; and three, that we tax those short-term capital inflows. So a triple whammy. Would that impact the Rand?
Well, I have to say that judging by what we've seen globally, certainly if you look at Brazil with regards to the tax implications, I mean, they brought in the 2% tax and that never really did anything. They then doubled that. And that still doesn't seem to have abated the flow that's moving into that industry at the moment. And the concern is, I mean, you've seen it in the Reserve Bank's accumulations over the last month. You saw what happened in Japan. Despite the aggressive intervention that's happening, currencies are still maintaining stronger levels. In fact, the yen today traded down at 81.75, which is much lower than the pre-intervention levels that we saw when Japan intervened.
But Peter Attard Montalto from Nomura International put out a note recently saying, if South Africa remains the only emerging market to do absolutely nothing, is there not a chance that the Rand will become the Swiss franc of emerging markets? And with no intervention, everybody will flock to the Rand and the strength will be unprecedented.
You know what I think that you've got to keep in mind is that South Africa, in terms of intervention perspective, it's really an expensive tool that doesn't necessarily get you the outcome. So you've got to concern yourself around the fact that if you're doing something that you know is unlikely to create the outcome that you're looking for, are you not being imprudent about doing that? When we look at exchange controls, that brings another situation into the mix. And I think that that's possibly something that certainly will be considered, and I think that that's something that's going to come up in the next medium-term budget statement, which will be quite interesting because I think, you know, in my view, initially, you might see a little bit of a fluctuation in the Rand, but possibly in the bigger scheme of things, funds ultimately will move into South Africa because one of the things that has changed in terms of what Wayne was saying earlier over the last 50 years is that the globe is now very concerned about Africa, African growth, opportunities in Africa, where a lot of peripheral European funds are now moving out of that zone because of the concerns around it and moving into a more Africa kind of focus. And you're seeing that out of the East and you're seeing that out of investors almost globally.
Just staying with these exchange controls, if we see them abolished completely, is there a situation at all that warrants taking money into the developed world? Shouldn't we rather just keep our money here?
No, if you take a 5-year view on the Rand, you're probably going to get good value going overseas now, and in 5 years you won't be disappointed. But the shorter term you could be. I mean, first of all, when foreigners love you, they love you no matter how ugly you are. So you can put on your worst clothes and put no makeup on, they'll still love you. In other words, you can tax, you can make restrictions, they're still coming here. When they come here, they come here. When they hate you, you can put on your best clothes and your best makeup, they're going. So it doesn't actually matter, quite frankly.
So you actually can't do anything to change the trend one way or the other, that's what you're saying?
You can maybe lean a bit against the wind, but understand exchange control effectively is already abolished. I mean, there is so little exchange control left here that it's largely symbolic, quite frankly. So abolishing exchange control, you can do it, Rand will probably strengthen. The tax story, that may work, I don't know. I'm always extremely reluctant to interfere with the capitalistic system because it can bite you. I mean, I've learned that.
But if everybody's interfering with the capitalistic system...
And I don't feel too strongly about it. A 2% tax or a 4% tax when you leave, I mean, understand, it's only if you leave within a certain time period do you pay this tax. That's not going to bother people who want to come here and invest. They say, I'm making a decision now forever. I mean, when you make an investment decision, you say, I'm buying Standard Bank shares. And I'm buying them forever because I think it's a good share. Now, if I make 30% profit in 3 months, then I'm getting forever up front. I'm getting my expected return up front. Then if you pay a 1 or 2% tax, what's the difference? You're still going to buy Standard Bank. So that will also have very little effect on it. Interest rates could have an effect, but unfortunately, cutting interest rates might shoot out problems somewhere else that you don't anticipate. So to come back to the original statement, when they love you, and there's not much you can do about it.
Euro dollar hitting 139.83 today. It went above 140 yesterday, and it did resume that weakening trend after the non-farm payroll number out. Credit Agricole's on the table saying, Simon Smollett saying 152 technically is what we can see on euro dollar.
We've seen the flow that we've seen this week is aggressively continuing to buy euros. Obviously, it's really the dollar weakness story. So you're seeing it across the board. You're seeing it in the Australian dollar. You're seeing it in the Canadian dollar, the Swiss, the yen, across all emerging markets. So it's really a dollar weakness story that we're talking about. In terms of the moves that we've seen today, I mean, yesterday there was a lot of profit taking, squaring out ahead of the non-farm payroll figures that we saw today. There was jobless data that came out yesterday, a little bit mixed, but the day before, the ADP figures pointed to a very negative
39,000 jobs lost in the private sector. That was Wednesday's data.
Recent data has really shown that ADP is a good leading indicator in terms of what you're likely to expect to see around the non-farm payroll.
So you're saying the market reacted on Wednesday?
Correct. But the bigger story is really what the concerns are around possible QE2 out of the US, and one of the factors that will drive that seems to be the outlook for unemployment, which obviously at the moment was the big swinger today, and that was really where the emphasis lay. So this number coming out disappointing the market, surprisingly so in terms of the fact that it was much more than what was expected. Just adds impetus to the fact that we are expecting QE2 to come through, and it looks as though that is a likely outcome, which ultimately means continued dollar weakness. And on the back of what Wayne was saying, I mean, ultimately, dollar weakness is across the board, and we certainly as a South African economy can't think that trying to accumulate some form of funds is going to stop the strength of the rand. Ultimately, what it's about is the sentiment, and how do we enhance that? How do we start to position ourselves as an economy that sits at the southern tip of Africa where there's so much opportunity? Rather worrying about the fact that the rand is so strong, how do we position ourselves in this country to attract funding, to position ourselves stronger going forward?
And those companies with large offshore exposure, perhaps if we take the message from Bridgette, need to position themselves for a strong rand.
Understand there has been a structural shift in the valuation of the rand. Not just recently, it's happened since we basically conquered inflation 10 years ago. So you'd probably say the effective exchange rate or the effective range for the rand is somewhere between 6 and 9, or 650 and 950, or it's somewhere in that range. That's the effective. But what we're seeing now, by and large, are cyclical movements. So they're not structural. Everything's in favor of commodities and emerging markets and all of this. Now that will change in 2, 3, 4 years' time. Everyone will hate emerging markets and commodities because that's the nature of markets and that's the cycle.
But
so
do you think that's really going to happen, Wayne?
Of course it will.
I think the world as we know it is changing. I honestly think that I think we're going to see a huge structural change. We've got this enormous momentum coming out of China. There's a lot of talk about the revaluation of the Chinese yuan, etc. There's a lot of things that we've never really had to consider before. And specifically from a South African perspective, we've certainly positioned ourselves a lot stronger than what we were 10, 15 years ago.
A strong currency is actually, we should all be celebrating it because it says the world loves us and we're worth more than what we were 2 years ago.
If you look at the currency as the share price of the country you're talking about.
But it also means that what we've put in place to this point is actually starting to pay off. That's why I'm saying we use what is paying off. Don't worry about the little stuff. Worry about the bigger picture. Consider the fact that this is an opportunity for us to seriously position ourselves in an environment that is considerably changing. And one of those changes are that Africa is the new portal for opportunity. And we form a very, very big part of that cog.
Yeah. Now look, I've got no problem with the longer term commodity super cycle, China, and the longer term African growth things. But unfortunately, managing money takes a much shorter viewpoint. And there are going to be cycles within an overall up or within an overall down cycle. So, a lot of factors at the moment are just so positive for South Africa and everything like that. But they are by and large cyclical. I mean, if the world survives, if the US economy survives, in 2 or 3 years' time, their interest rates are going up. And then the interest rate differential slows. Their interest rates are going up because their growth is going up. Then the growth differentiation, that sorts itself out. And then eventually Americans say, hey, things aren't so bad at home. I'm earning 4% now. I only earn 6% in South Africa. I mean, let me pull some money. I mean, these are cyclical things. It happens all the time.
Do you believe the US is going to survive?
I think that they're playing a very dangerous game. They're in a lot of debt and they're talking about increasing that. And certainly now with the QE2, that just means that it really confirms the fact that they're very, very concerned about their growth outlook, and they're certainly concerned about how they are going to create this momentum that's going to carry them through. Because I think what a lot of people initially thought at the beginning of this crisis, that it would be a 2, maybe at the absolute outpost 3-year situation we would be faced with. We're going into the 3rd year of this, and there still isn't a massive light at the end of the tunnel, and that's where the concern lies.
We can't go without talking about the potential currency wars that are headlining around the globe at the moment. Do we take this seriously?
Well, it was, as we discussed earlier, I think the IMF have got the meeting this weekend. There will be a lot of debate around that. What do you do when the entire globe is in one of those situations? Unless it's a concerted effort, and we said this when the Japanese intervened, to try to do it on your own is almost impossible. It has to be a unified front that make decisions around rebalancing the global economy.
Do you think that's likely to happen? Are all policymakers going to go in the same direction?
Look, fortunately, when politicians truly have their backs against the wall, they do logical things. So you probably find there won't be a currency war, because I don't think that serves anyone's good. I don't think that will help anyone at all. But, you know, as we've also spoken about a few times, unfortunately, this is silly season in America. It's just before the midterms. So there's going to be a lot of positioning, a lot of rhetoric. People are just going to talk for the sake of talking and getting more votes in the election. But hopefully, you know, level heads prevail and we don't see some sort of war. Because the mere fact that it's called a war, markets and economies don't like that. It's not good
news. And we
news.
Desperately need the Chinese economy right now to take us
Yes.
through this. And unfortunately, that is something that we need to consider. I mean, as a South African economy, we're benefiting from some of that. You're seeing it in Germany. They're increasing their exports to China. It's helping to sustain a couple of economies. The problem is there's a massive offset in terms of the United States, and Wayne's 100% right. You've got to be very careful about how you word exactly what you're trying to.
Do you think we'll see the US pushing the yuan to appreciate, with the Chinese premier recently coming out and saying a 20% appreciation in that yuan will result in widespread losses in the export industry, job losses, company closures in the export industry in China?
Absolutely. I think that the US will continue to press because it's good politics.
Yeah.
But whether they get it right or not is a completely different story, and I don't think that they will get it right. I think that at the moment China has too much power and we really do need them. Ultimately, we need that economy to continue to grow.